Hi chartered, hope so you're all doing great. In today's video, we are diving deep into an essential financial concept that's crucial for the students pursuing their careers in CFA, CPA, CA, and ACCA. We are talking about the DuPont's ROE, the return on equity. To kick things off, let's talk about what's DuPont's ROE is all about. So let's have a brief about who is DuPont, or rather I would say what is DuPont. DuPont is basically a company, and the DuPont's ROE model was given by a finance executive. Just like you guys will be coming in future, a finance executive in a big company just like DuPont. So a finance executive over there in DuPont gave the formula for the ROE. So the financial metric that was given by the finance executive there at DuPont breaks down a company's ROE into various components, thus giving a clearer picture about the drivers that basically drives the company's profitability. So this tool or this financial metric, I would say so, is hated by the students because it is increasing their syllabus, right? But as a financial analyst, as a person who is deep into stock markets and all that thing, capital markets and all that stuff, that person really loves, I would say so, he really loves this model because it is giving a way broader picture of what ROE is all about. Okay, so let's have a clear idea about what is the DuPont's ROE. So let's get started. So traditionally we calculate ROE like this. So what is ROE? First of all, ROE is return on equity. Okay, so what is the return that is earned by the equity shareholders? Exactly, the earnings attributable to the equity shareholders is nothing but the earnings of the equity, right? So basically we say that earnings attributable to equity shareholders is nothing but profits after tax, which is nothing but, what is the other name for PAT? Can anyone tell? Exactly, very nice, profit. So when we reduce preference dividend from the profit, from the net profit rather, we get PAT. We get earnings attributable to equity shareholders, and when we divide the earnings attributable to equity shareholders by the shareholders fund, and can anyone tell me what is the other name for the shareholders funds? If you said net worth, you got my thumbs up. That's great. So net worth is the other name for the shareholders funds, right? So keeping that in mind, what DuPont's financial executive did, he just simply first of all wrote the formula that EAT upon equity is what we call as ROE. And if I multiply it by revenue and then divide it by revenue meaning sales, right? I hope everybody knows this thing, right? Is it impacting the ROE ratio? It simply cancels it out, right? So it has no impact. But if I replace the denominator of this with this, what would be the situation? It would be like EAT upon revenue into revenue upon equity. Okay, so this is the situation. Now can anybody tell me what this ratio looks like? If you said it looks like the net profit margin, net profit ratio, you are on the right track, right? So net profit margin. And similarly, can anyone tell what this ratio looks like? Exactly, it looks like this is a new ratio, I would say so. But as I always say that ICI is not that sweet with you guys, right? So you have to just think beyond imagination, right? So it is equity or equity turnover ratio. Remember the turnover ratio. In order to achieve this much of sale, how much are we investing? How much are we dedicating, right? So that's we call as the turnover ratios, right? So can we say that ROE is nothing but net profit margin into equity turnover ratio? Yes, we can definitely say so. Okay, keeping that in mind, let's move ahead, right? So EAT upon revenue into revenue upon equity, right? this EAT upon, EAT upon revenue into revenue upon equity, EAT upon revenue into revenue upon equity. And if again I multiply average assets and then divide the same by average assets, will that have any impact on the entire ROE ratio? No, because simply average asset would cancel out with average asset. But now if I replace this average asset with equity, what would be the situation? It would be EAT upon revenue into revenue. Now equity replaced by average assets, so average assets into average assets upon equity. So if you have a look, so basically what is happening, EAT upon equity, the original formula, right? EAT upon equity, the original formula, right? So what actually are we doing? We are actually trying to just manipulate the original ratio itself, right? So basically now can anyone tell me what is this? This is still remains the net profit margin, right? What is this ratio? It is assets turnover ratio. And can anyone tell me what this ratio is? So basically, as far as CA students are concerned, as far as you guys are concerned, we call it as equity or equity multiplier. Okay, but when we teach the CFA, ACCA and CPA students, we generally call it as the financial leverage ratio. This term is not relevant for you guys as far as your curriculum is concerned, as far as your syllabus is concerned, but you must have a complete idea about the basically complete idea about what the alternate names for one single thing is, right? So ROE is what? EAT upon revenue into revenue upon average assets into average assets upon equity. So basically what we can say, we measure the operating efficiency from the net profit margin ratio, from the net margin ratio, your net profit margin ratio. So operating efficiency is measured, basically operating efficiency indicating how well the company's operations are going on, right? How well the company's operations are going on is measured through the net profit margin ratio, right? When it comes to the asset turnover ratio, basically it is indicating the asset management efficiency. Remember what was the other name for this turnover ratios? There were multiple names and I requested you guys to write down the other name too. Remember? Can anyone tell me the other name for the turnover ratios that I asked you guys to write down? Yes, exactly. And this is what we call as the equity multiplier for the CA students, and for the CFA students, CPA students and the ACCA students who might be watching this video, it is financial leverage ratio. Okay, so in case the ROE rises, it means that the net profit margin ratio is rising, it means that the asset turnover ratio is rising, and finally it means that the equity multiplier is rising. But if we consider the same, it means that the operating efficiency is rising. That's good for the company is happy with it. It means that the asset management efficiency is rising. That means that the company's assets are generating better sales, the company is happy with it. But in case the company's financial leverage, that is the equity multiplier, rises, if equity multiplier rises, then it's not a good situation for the company. Then the company is in tears. Why so? Because basically the name as per the ICI equity multiplier is a bit confusing, I would say so. That is the reason why I asked you guys to just understand it as the financial leverage ratio. Financial leverage means the company's equity is falling. Basically, the company's assets are not getting financed through equity, they are majorly getting financed through the debt capital. So that is majorly getting financed through the debt capital. Okay, so in case the company's ROE is rising, it is by itself, I would say, so it is by itself is not a good indication. We have other measures to consider well the ROE of a company is rising, that include the net profit margin, that include the asset turnover ratio, and that includes the equity multiplier.